key trends on structured products for the year. I'm going to focus in three, which I think are very relevant. The first one is capital protected. I mean, when structured products back in the 90s, it was 90% of all products sold. And with higher interest rates that we had last year and still this year, I think a lot of the small issuer local banks are coming back to structured products because they can reduce the products which are capital protected. And although we see now the yield curve changing, the ECB and the Fed thinking about stop the hike of interest rates, we still see an increased demand of capital protected products, even more with the potential bear market, the potential financial crisis that everyone is talking daily nowadays. Capital protected products are still very relevant, especially market-linked CDs in the US, as well as structured deposits in Europe, as well as GICs in Canada. Then the second trend is credit. Again, I'm going to highlight again the shift on the yield curve, the interest rates expectations. I think we see now some people playing around on credit. Credit-linked notes are becoming more popular. All the banks are trying to push those. And that's because, some of the banks don't really need the funding level, and having the credit-linked notes, it allows them to create, synthetic credit using the low bond prices that are in the markets, giving a yield back to the clients. And I think this will be a trend mostly on the most of the wealth clients and professional investors. There still seems to be a lot of value there. And last, and I would highlight again, is the shift from stocks, shares, like banking sector, technology were very hit last year. It was a bad performance for investors in the US as well as in Europe. So I think we're seeing a shift into equity indices once more, and because vol is high, you also don't need to pick up the equity risk on single stocks. So we see that will continue to increase. I think there will be a need from investment banks to diversify their indices, because at the moment what we see is that clients always follow the same trend, same index, and then that becomes very difficult for investment banks to manage that risk. So I think we'll see a diversification on the equity indices being used in structured products.